Hello and welcome to Explain the Charts, your go-to channel for in-depth market analysis. Today is October 1st, 2025, and the market has just been hit by a seismic shock that has taken everyone by surprise. The S&P 500, after closing out its best third quarter since 2020 yesterday, has experienced a catastrophic gap down overnight, wiping out months of gains in a single session. To understand this move, we first need to look at the news that has been building over the past few weeks. Wall Street has been bracing for a potential U.S. government shutdown, with prediction markets giving it a greater than 90% chance of happening by today. That shutdown is now a reality, and with it comes a halt to crucial economic data releases, effectively blinding the Federal Reserve ahead of its next meeting. On top of the shutdown, President Trump's newly announced tariffs on a range of goods, including pharmaceuticals and lumber, were also slated to take effect today, on October 1st. This double whammy of extreme uncertainty appears to have shattered the market's recent confidence, which was previously buoyed by a resilient economy and an AI-driven tech boom. Now, let's turn to the charts to see the devastating impact of these events. Looking at the daily chart for SPY, we can see the incredible bull run the market has been on for over a year. Price methodically climbed, setting a new all-time high just last week on September 22nd at 667.29. The market even closed strong yesterday, September 30th, rallying to finish the quarter at an impressive 666.18. This created a sense of calm, suggesting investors were perhaps underestimating the risks. But as we can see with this latest candle, that calm has been shattered. This morning, the market gapped down from yesterday's close of 666 to an open of 573.40, a staggering drop of nearly 14%. The price then sold off further during the day, hitting a low of 566 before finding some temporary footing. Let's switch to the 15-minute chart to see how yesterday's final trading session played out. Here we can see the price action for September 30th. The market was choppy, but it staged a powerful rally into the close, pushing to the highs of the day. This price action demonstrates the market's attempt to shake off the shutdown fears right up until the final bell. It was a classic buy the rumor scenario that completely reversed when the sell the news reality hit overnight. Now, back on the daily chart, the technical picture has been completely redrawn. The most immediate and obvious feature is this massive gap between 661 and 574. This area now represents a colossal wall of overhead resistance. Any attempt to rally will face significant selling pressure here. The prior support level around the 650 to 660 zone is now irrelevant in the short term. Today's low of 566 is our first critical support level to watch. If we break below that, we could see a rapid move down to the next support zone. Looking back on the chart, the trading range from May and June of this year between 580 and 590 has been completely sliced through. The next significant area of potential support comes from the March lows around the 550 to 555 area. Below that, the major corrective low from early April sits way down near 500. This gap down has effectively erased all gains since mid-May. Volume on this move has been immense, confirming the panic and conviction behind the selling. This is a clear trend reversal signal on the daily time frame. Let's consider the scenarios from here. The bearish case is strong. The combination of political chaos, a data blackout for the Fed, and escalating trade tensions could fuel further selling. A break of today's low at 566 would likely open the door for a test of the 550 support level in the coming days or weeks. The market hates uncertainty, and we are now in a period of maximum uncertainty. However, there is a contrarian bullish case to consider. Moves of this magnitude can be emotional overreactions. Any positive news, such as a surprise deal to end the shutdown, could trigger a violent short-covering rally. A move back above 574 and a stabilization in that area would be the first sign that the worst of the panic is over. Traders looking to go long would need to see a clear bottoming pattern form before stepping in, as catching a falling knife is extremely dangerous. For now, the risk is clearly skewed to the downside. So, to recap, the entire market landscape has changed in 24 hours. The long-standing uptrend is broken, and we are in a new, volatile environment. The key resistance level to watch is the bottom of the gap, around 661, though even getting back to 580 would be a significant short-term win for the bulls. On the downside, the key support levels are today's low of 566, followed by the March lows around 550, and then the major April low near 500. Given the fundamental reasons for this sell-off, I believe there's a 70% chance we test the 550 level before we see any meaningful, sustainable bounce. This likelihood would increase if we close below 566 tomorrow. Conversely, if politicians announce progress on a deal, we could see a rapid attempt to fill a portion of this massive gap. Moving forward, stay extremely cautious. Watch the headlines closely for any news on the shutdown and tariffs, as they will be the primary drivers of this market. Thank you for joining us on Explain the Charts. If you found this analysis helpful, please hit the like button and subscribe for more updates. Trade safe, and we'll see you next time.